Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first 7 private AI firms build a $1.3 trillion shadow stock market, creating a bubble. Sam Altman admits is insane. So we'll discuss why Sam Altman calls this a bubble while planning to spend trillions and what it means for the AI investment landscape. Second, Nvidia's stunning $5 billion investment in rival Intel reshapes Silicon Valley, aiming to hedge against TSMC's dominance in advanced chip manufacturing. We'll explore how this surprising alliance could transform the global semiconductor supply chain and impact the US-led chip manufacturing race. Third, Alibaba's $53 billion AI pivot disrupts the market with a new PPU chip that matches sanctioned Nvidia GPUs at 40% lower cost. Today, we'll take a closer look at this chip breakthrough and its implications for China's tech self-sufficiency and the global AI hardware race. Fourth, Elon Musk denies fake news of xAI's $10 billion raise at a $200 billion valuation, creating a paradox around his gigafactory of compute plans. We'll analyze why this public denial is a critical moment and how it could affect investor confidence and xAI's race against OpenAI. Fifth, AI tools meant to reduce workplace burnout are actually increasing it, with 45% of heavy users reporting higher exhaustion due to cognitive overload. This discussion will reveal how this connects to a 150-year-old economic theory and what it means for the future of enterprise AI adoption. Let's start with a single statistic that just might change your perspective on the tech world. Just 7 private companies are now worth a staggering $1.3 trillion. Their value has almost doubled in the last year alone and quadrupled since ChatGPT first launched. What's flying under the radar is how this is creating what experts are calling a shadow stock market. Unlike public companies, these private giants operate without the same transparency. The issue is that while paper valuations are skyrocketing, the foundations can be shaky. For instance, recent data shows the median growth rate for these private unicorns has plummeted from nearly 68% in 2021 to just 14% recently. It's a high wire act without a public safety net. We've talked before about how the AI rush concentrates power. This shadow market is exactly that, just with less sunlight. And remember, OpenAI's cap profit setup leaves a massive equity stake with its non-profit parent, meaning lots of control, but little disclosure. This isn't your typical startup story. We're talking about a new class of private titans led by Elon Musk's SpaceX, valued at $456 billion, and AI leader OpenAI at $324 billion. They are joined by rivals like Anthropic and Musk's other venture, xAI, which is reportedly raising $10 billion at a $200 billion valuation. And the knock-on effect of this AI gold rush is a capital vacuum. While a handful of AI companies get showered with cash, other critical sectors are facing a drought. We've flagged before that AI's share of US venture money has jumped to roughly 71%. In 2024, AI startups have attracted nearly 35% of all US. Startup funding, while global funding for non-AI startups actually declined by about 10%. We're talking about potential breakthroughs in biotech or climate tech that are struggling to get noticed. Continuing our last discussion on capital concentration, the latest development is this. According to Forge Global, just 19 AI firms have vacuumed up $65 billion in funding so far this year. That's 77% of all private market capital. The CEO of Forge put it bluntly, "We've not seen this in the private market ever." But that growth isn't as simple as customer sales. Take OpenAI. A huge part of its financial structure is its deep partnership with Microsoft, which has invested a staggering $13 billion. A lot of this revenue is actually a complex mix of cash, cloud credits, and intercompany payments. In fact, despite its massive valuation, OpenAI was projected to have lost over $500 million in 2022 because building these models is so expensive. Layer on the cap profit governance, and the accounting gets even more nuanced. But that's not the whole picture. The real turning point is when the man at the center of it all, OpenAI CEO Sam Altman, went on the record and admitted we are in a bubble. He called the current valuations insane. So here's the strategic paradox at play. Why would a CEO admit he's in a bubble? Altman is essentially saying that while short-term valuations are overhyped, the long-term transformative power of AI is being underestimated. He believes you have to build the foundational infrastructure now, even if it looks reckless today. And in the same breath that he calls it a bubble, he reveals his real plan. He said, and this is a direct quote, "You should expect OpenAI to spend trillions of dollars on data center construction. We will spend maybe more aggressively than any company who's ever spent on anything." This isn't just about insane valuations. It's an arms race for the future, funded by unprecedented capital, with the leaders betting trillions that they are right. And that level of spending just cements the centralization risk we've been tracking. We were just talking about the trillions being poured into AI infrastructure, and that brings us to the hardware giants making it all possible. A seemingly impossible collaboration became a reality yesterday. Nvidia announced it's investing $5 billion in one of its oldest rivals, Intel, to co-develop data centers and PC chips. The move seems counterintuitive for the dominant leader, but it's a calculated strategic hedge. Right now, the most advanced chips are almost all made by one company in Taiwan, TSMC. This partnership allows Nvidia to diversify its manufacturing and reduce that massive geopolitical risk. For Intel, it's a golden ticket back into the high-performance AI game. The plan is to combine Intel's factories with Nvidia's GPU designs. And as we've discussed before, the choke points aren't just fabs. This deal also helps offset the single point of failure risk around HBM memory, which is tightly aligned with TSMC. One important boundary, though, for its crown jewels, Nvidia is still sticking with TSMC for now. This comes as Nvidia has exploded to become the largest stock in the US with a market cap over $4 trillion. CEO Jensen Huang recently called his new Blackwell platform the next generation AI the world's been waiting for, adding that demand was extraordinary. And with competitors like Broadcom pushing alternatives, locking arms with Intel also widens Nvidia's moat. Interestingly enough, that extraordinary demand comes with a massive hidden cost. Electricity. The International Energy Agency projects that by 2030, data centers could nearly double their global electricity consumption, largely because of AI. Some of these next-gen GPUs are expected to use 1,200 watts per chip. This means the entire AI boom could hit an energy bottleneck, where the cost of power and cooling becomes a major roadblock. That demand is creating a gold rush on Wall Street. While the S&P 500 is up around 13% this year, the go-to chip fund, the VanEck Semiconductor ETF, is up nearly 30%. It's a nearly $30 billion fund, with Nvidia alone making up over 20% of its portfolio. The fund is market cap weighted, which simply means the bigger a company's value, the bigger its slice of the fund. With Nvidia's massive size, it naturally dominates, creating a highly concentrated bet on a single company. This situation presents a fascinating duality for investors. For every person piling into that concentrated fund, there's another looking at a radical alternative. A different fund, the SPDRSP Semiconductor ETF, takes the opposite approach. It gives smaller players equal footing, meaning Nvidia's weight in that fund is under 3%. It's a bet on the entire sector, not just one titan. So who are these smaller players? We're talking about the picks and shovels companies building the essential plumbing for the AI gold rush. Think of Astera Labs, which solves the memory wall problem, or Credo Technology, which builds the critical data highways that let GPUs talk to each other. These are the unsung heroes whose tech is vital for the next phase. As Wall Street rolls out even more specialized funds from Fabulous only to momentum-based plays, one thing is clear: this isn't just a market trend, it's a fundamental reshaping of the tech landscape. As one top product manager put it, we believe this is a super cycle. We're in the very early innings. Speaking of the high-stakes chip game, another major player is making an aggressive move. But on the other side of the world, after years of losing ground, e-commerce giant Alibaba is pivoting hard, betting its entire future on a $53 billion investment in artificial intelligence. Since late 2022, Alibaba has already poured over $3.3 billion into AI startups, from humanoid robotics to AI video generators. To understand the scale of this, look at their investment in X Square Robot, which has built a wheeled humanoid robot named the Quanta X2. This 5'8" robot can perform delicate tasks like gripping objects or even mopping. The goal is to use them in Alibaba's warehouses and beyond. A huge bet on automating the physical world. And the results are already showing the company's US traded shares have surged by more than 90% year to date, and its cloud computing revenue just jumped 26% in a single quarter, driven entirely by AI demand. Now, get this. AI and cloud computing are fundamentally intertwined. Developing powerful AI models requires a massive amount of computing power, which is exactly what cloud services provide. By building up its cloud division, Alibaba isn't just selling server space. It's building the foundational engine for its own AI ambitions and for thousands of other Chinese companies. However, if you zoom out, you'll see another layer of strategy at play. According to one analyst, Alibaba is positioning itself as China's most aggressive AI investor, with spending that rivals US tech titans. So the thing is, this isn't just about spending money. Alibaba is walking a fine line. It's aligning with China's national goal of tech self-sufficiency, becoming a national champion in AI. But to keep international investors from getting nervous, it has also open sourced hundreds of its AI models, which have been downloaded over 300 million times. This move builds trust while strengthening its position at home. This isn't just a new strategy, it's a fundamental shift in identity. One expert says the old e-commerce business is now just the cash flow to fund these high-tech ambitions. This is a move to become a core technology company. And that chips part of the equation is the most critical piece of the puzzle. Because of US export restrictions, China can't easily buy the most advanced AI chips from Nvidia. So Alibaba's semiconductor division developed its own, called the PPU. Recent reports show this chip actually matches the performance of sanctioned Nvidia chips, and its production cost is reportedly 40% lower. This allows Alibaba Cloud to slash prices for its AI services, giving it a massive competitive edge inside China. They're not just working around the restrictions, they're trying to turn them into a long-term advantage. It's a comeback story after the company scrapped plans to list its cloud unit and faced a record fine. Now, analysts are calling it a sea change, with one expert describing the new Alibaba as a unique hybrid of Google plus Amazon. The gamble here is that becoming a hybrid of Google plus Amazon is an incredibly difficult full-stack gambit. It means trying to excel at e-commerce, logistics, cloud, AI models, and semiconductors all at once. The risk is spreading resources too thin, but if it works, the synergy could be unstoppable. As one analyst put it, Alibaba is now arguably China's strongest private sector contender in the global AI arms race. Alibaba isn't the only one making headlines with staggering investment figures. Over in the US, the story begins with a decision that caught everyone by surprise. Elon Musk's XAI is reportedly chasing a $10 billion raise at a staggering $200 billion valuation. But what really brought this to a head was Musk's public response. In a post on his own social network, X, he called the report fake news, stating flatly that XAI is not raising any capital right now. This creates a massive disconnect. You have a valuation that rivals industry giant Anthropic, chasing market leader OpenAI, and a public denial from the man in charge. So why would investors even consider such a high price tag, especially when XAI's main product, Grok, is seen as technologically behind? Actually, investors aren't just betting on the current product. They are betting on three things: Musk's track record, the exclusive access to X's vast trove of real-time data, and a future hardware strategy that could change the game. The situation gets even more intriguing when you look at the numbers. This rumored deal comes just weeks after XAI reportedly raised funds at a $150 billion valuation. The money would fuel Musk's ambition to build a massive supercomputer in Memphis and buy 1 million AI chips. This isn't just a server farm, it's being called a gigafactory of compute. The plan is to build the world's largest supercomputer in Memphis, Tennessee. And the implication is that one company attempting to corner such a huge portion of the world's advanced AI chip supply could strain the entire global market, impacting everything from competition to academic research. But the company is not without serious controversy. Its Grok chatbot has been criticized for incidents where it praised Adolf Hitler and made unsolicited comments about white genocide. This raises a critical question: are these just technical failures or a deliberate feature? XAI has positioned Grok as a maximally truth-seeking and anti-woke AI, suggesting a strategy to appeal to users who want unfiltered information. The risk, of course, is that the platform becomes a reliable engine for generating hate speech and misinformation. This is the same company that merged with X in a deal valuing the social media site at $33 billion, a significant drop from the $44 billion Musk paid for it. And that merger is more than just a corporate shuffle. Believe it or not, XAI's exclusive access to X's massive real-time conversational data is its secret weapon. It provides a continuous stream of unfiltered human interaction to train its AI. However, it also means training the model on a dataset known for its toxic and chaotic content, which creates huge ethical risks of the AI learning and amplifying those same harmful behaviors. And while XAI battles for funding, another number hangs in the balance. Tesla's board is asking investors to approve a new pay package for Musk that could be worth as much as $975 billion. We've been talking a lot about the race to build bigger and more powerful AI, but let's shift our focus to the human side of the equation. It turns out the very tools designed to save us from workplace burnout might actually be making it worse. A massive new survey found that 45% of workers who frequently use AI report high levels of burnout. For employees who don't use AI at all, that number is just 35%. This is a bombshell for an industry grappling with a problem that costs a single company up to $5 million a year. The promise was simple. AI would automate the 13 hours a week employees waste on repetitive tasks, freeing them up for more creative and human work. And for some, it worked. One study showed a 25% drop in emotional exhaustion in workplaces that adopted AI. Experts called tools like ChatGPT a phenomenal thinking partner and the biggest opportunity of our time. So, why the paradox? Why are the heaviest AI users burning out the most? At a neurological level, something fascinating is going on. When we collaborate with AI, our brains aren't just taking a break. Research from cognitive psychology shows this partnership can actually elevate our cognitive load. We're constantly evaluating, prompting, and checking the AI's work, which can lead to a specific kind of mental exhaustion called decision fatigue. One expert warns that using these tools all day can feel the same as spending 9 hours at the gym. It's a tricky situation for our brains. Because AI is a thinking partner, we can fall into a trap of cognitive complacency, over-relying on its output. But at the same time, we know we can't fully trust it, so our brain is working overtime in the background, leading to that higher cognitive load and burnout without us even realizing it. And here's the core of the issue. From Headspace's Chief Clinical Officer, Dr. Jenna Glover. She says that for many, AI isn't actually reducing the workload. Her words, instead of lightening the load, it's actually just creating room for more to be put on your plate. This all connects back to a 150-year-old economic theory called the Jevons paradox. The theory states that when technology makes a resource more efficient, we don't just use less of it, we actually end up consuming more. Essentially, when AI makes a task faster and cheaper, the demand for that task just explodes. For example, in customer service, AI chatbots handle simple questions, but this has raised customer expectations, leading to a flood of more complex problems that only human agents can solve. The workload doesn't decrease, it just changes and often intensifies. The technology sold as a savior is, for some, becoming a trap. The efficiency gains are real, but they're being met with even higher expectations, pushing employees right back into the very burnout AI was supposed to eliminate.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.